released its Sub-Saharan African outlook. And some interesting numbers in there. Well, there's good news. At least 2/3 of the countries studied will grow better this and next year than they did in the previous one. So that's not too bad. But there are still major challenges. So they call it a tepid, a tepid recovery. Yeah, that's true of tea, of soup, can also be true of a recovery. So we'll be speaking to a very important person from the IMF on this matter. She's a deputy director in the IMF's African department, where she oversees work on several countries and the regional economic outlook publication. She also works on climate change, capacity development, gender and research. And good news, she joined the fund from Oxford. So yeah, she worked in the academic world before she jumped into this behemoth. So what are we talking about? We want to look at the highlights of the latest outlook that for Sub-Saharan Africa, the IMF put out. What does it say about the recovery? How well will countries grow? Somebody says misery lacks company. Ghana has been going through many challenges in the past couple of years. We're actually told that we are in the era of poly-crises. So after COVID, we had all kinds of things. Inflation is a big challenge. Debt crisis. Even in Ghana, there's a semi-power crisis. So what is the outlook for the Sub-Saharan African region? What does this mean for economic growth? There's an election coming up in about 10 countries within the sub-region. How will this affect prospects for growth? A number of countries didn't have access to financing on the international markets, Ghana being one of them. Is it such a bad thing that you can't, for example, put out a Eurobond? And how can we increase the kind of funding that the IMF makes available to countries? All of that coming up in the next 20 to 30 minutes. Let me say good morning to Dr. Pattillo. Welcome to the show.
Thank you. Great to be here.
It's good to have you. Did I mention your name right?
Yes. Mm-hmm.
Pattillo, I see. So are you enjoying your transition from Oxford to the IMF? Is it a nice shift?
Indeed. I mean, working at the IMF is wonderful because you get to work on so many different issues and so many different countries.
Wonderful. So this latest Sub-Saharan African economic outlook, what are these outlooks? How often do you do them? What do they try and say?
Thank you. So we do the regional economic outlook for Sub-Saharan Africa twice a year, in the fall and in the spring. The objective is to have a publication that looks at economic developments in the region, looks at the prospects, looks at, policy recommendations, and we think it fills, a gap because there's a lot of analysis out there on a lot of other economies, but not enough on Africa, particularly on some of the macro aspects.
Yeah.
We also think it influences the debate that we hear people saying these are interesting issues you're bringing up, because we, in addition to this, look at the overall picture. We also have 3, topical notes on topics that are of interest in the day.
Africa is a diverse place. SSA has probably 40 countries. How difficult or easy is it to try and aggregate? I notice you try and sort of categorize some as resource intensive, Just walk us through the way you try and make sense of such a diverse continent.
Indeed. So there's a lot of differences across countries, and we don't want to make people think, there is one Africa or there is one story. But it is useful, I think, to try to have a narrative about some of the big issues that affect lots of different countries.
Yeah.
So indeed, we break data down by different subgroups, looking at the resource intensive, that's those that export oil or export other commodities, versus those that are more diversified, or countries that are, fragile or conflict affected. The frontier markets compared to those who are, in the markets compared to some of the lower income countries that don't. So we do try to break it down, but also to see what are some common themes.
What's the context for this report in terms of what's been happening before? We're told that we've had 4 difficult years, and I think somebody said we are in an era of poly-crises or poly-shocks. Just talk a bit about the background to this latest outlook so people can get the reason why you're describing it as a tepid but pricey recovery.
So the region has faced 4 really, really brutal years because of all of these poly-crises. And like the rest of the world, the COVID pandemic had really, really horrible impacts on economies, people's lives. Think about schools that were closed for so long, and you have the scarring of that. Immediately after that, then you have the Ukraine war, food, fuel, fertilizer prices skyrocketing.
All the F's.
Right? With again, big implications. We're seeing what we really thought was a cost of living crises in a lot of countries because of these high prices that affected people and affected, for example, food insecurity. So we'd had a big food insecurity crisis, I would say, with 146 million people in the region, termed food insecure, and that continues. Then now we have the, Gaza, the war in Gaza, Red Sea disruptions, some implications for volatility in commodity prices, and climate shocks, the continuation of climate shocks. So indeed, poly-crises and lots of difficulties. So the report is highlighting that after these brutal years, we are seeing some encouraging signs. And so our message is that the region does seem to be on the mend, but there are these persistent challenges. And in terms of the encouraging signs, I could mention 3 of them. So first on growth, as you noted, we're projecting this aggregate average growth to increase from 3.4% in 2023 to 3.8% in 2024, and then 4%. And so this, again, thinking about the context, during the pandemic, growth plummeted completely. It rebounded in 2021 and then went back down. So this is the first year we're seeing an improvement after that 2 years of decline. And 2/3 of the country are going to see this increase in growth. So it's not just a few big countries driving it, it's pretty widespread, and that's significant. So that's the first encouraging sign. The second encouraging sign is that these imbalances on the macroeconomic side that affect economies and affect people, we're seeing them moving in the right direction. So say inflation, something everybody sees. And again, for the region, we are seeing inflation declining. There was a peak median across all the countries of around 10% in late 2022. Now we're down to 6%. So that is in the right direction. On the fiscal side, again, the fiscal deficits in all the region had gone way up again during the pandemic. Tax revenues collapsed. Governments needed to spend to support their populations that were hurting. Deficits went way up. Debt also high. And now we're seeing these fiscal deficits go down. And debt, which had been on a continuous rise for the past decade, up, is now, again, the median across all the countries, stabilizing at around 60%.
So those are the three key highlights. Growth projected to grow better than previously, inflation halving, and the debt situation stabilizing.
Yeah, I would put the inflation and debt together as a macro improvement. The third encouraging sign is that there are countries returning to the international capital markets, right? So for 2 years, no frontier market in the region had accessed international capital markets, completely shut out. And now we had, at the beginning of this year, Cote d'Ivoire, followed by Benin, followed by Kenya. So market sentiment is improving for African sovereigns. Those are the three encouraging
Let's talk about
signs.
the first one, Doc. Okay. So the growth figure, does it take into consideration El Nino? I ask this because in Ghana, we notice cocoa yields have come down, in Cote d'Ivoire as well. I think a lot of the southern African countries are very agric dependent. And this weather phenomenon, we are told, is going to devastate agric. Did your projection occur before we saw the full extent of El Nino, or it takes cognizance of El Nino?
It was before, and so I think we are concerned about those impacts that we're seeing. As you noted, in Southern Africa, they're facing really a devastating drought. Malawi, Zimbabwe, Zambia, and of unparalleled severity for decades. And then in East Africa, you're seeing a lot of flooding in a number of countries. So this impact is going to be felt, and given the potential impact on agricultural sectors, could mean that we'll have to look at those growth projections again.
But the projections did take cognizance of the fact that a lot of the countries' Eurobond payments are due this year later and early next year as well. Because for Ghana, for example, there are quite a number of payments due in 2025. So are we still going to grow by this 3.8, even though quite a lot of our monies will go into paying just interests? Not even the principal, just interests, right? Does the outlook take cognizance of that fact?
So yes, we were getting to some of those challenges, and indeed the first challenge that we highlight, that all is not rosy, and there are these big difficulties. The first challenge is that what we've termed the funding squeeze, it's still very much in effect. And that is this very high cost of financing and the shortages of financing. And the significant repayments that you mentioned that are coming due, that mean countries have a lot to deal with in terms of the debt situation. So what we found when we look, for example, at the public sector and the external flows to the public sector, so that's the net external flows, looking at all the things that come in from aid, from the World Bank and IMF, from China, or from the private bonds, loans, etc. Those inflows minus the outflows, the principal and repayments that are due, that those net flows are at the lowest level since the global financial crisis, way back then. And for some countries, they're negative. So this is a big challenge. And as you mentioned, when we look at the ratio of what countries have to pay in interest compared to the revenue that they have, they're spending more on that interest as a share of their revenue than for a long time. Those payments have doubled again in the past decade. So that is one of the really big continuing challenges.
This is the Citi Breakfast Show. We're talking to Catherine Pattillo. She's the Deputy Director in IMF's African Department, and she oversees work on several countries. and of course they've published the Regional Economic Outlook, which has a very interesting heading: a tepid and pricey recovery. Basically, the recovery is not that sweet, and it's also going to be expensive. So even though it's a recovery nonetheless, but it's a recovery with asterisks. I just wanted to get some clarity on a couple of points. So it seems to me as if the African continent, many years ago, we're told we are insulated from global ups and downs because we're not so integrated into the world financial system. So when the Great Depression and all those things occurred, yes, we were affected, but not so much. But now we're on Eurobond markets where for example, US Fed, they raised their interest rate and boom, all currencies are falling. Is it such a good thing to be integrated into the global economic system? Because we don't have the buffers to support ourselves. And so when the world coughs or when the US coughs, we all catch a cold. Just talk to me a bit about African countries and the integration to the world economic system, whether that should be with a caveat or better integration is always good.
I think the history of countries developing is that more outward orientation and particularly more integration in trading with lots of different countries is very important for growth and development. Mm-hmm. It then allows you to make sure the economy is growing and being more competitive, being productive, finding different markets, working on producing different things. So that kind of integration in trade, in particular, is valuable. Mm-hmm. On international capital markets, as you note, there are ups and downs and benefits, but also risks that countries have to be cognizant of. But if the idea is also making sure you're able to get different financing sources and diversify your financing sources, then access externally seems like a good thing. But those flows can be there when times are good and not there when you need them.
Let's discuss that a bit more. So you said there were 3 good points. The growth was a good thing.
Yeah.
The imbalances, inflation, fiscal deficit, and then you said the return to the international capital markets was good. I want to contest that in the sense that, so some would say, look, we got into this mess partly because we were overexposed to especially expensive commercial debts like the Eurobond, right? So let's take Cote d'Ivoire. They're going back to the international capital market. Cote d'Ivoire is borrowing with a spread of 10%. 10% is really, 10.4 is very high. In fact, the payments due this year for Cote d'Ivoire was for Eurobonds taken at 6.9%. So you're already struggling to pay 6.9, and then now you're going to borrow at 10%. I mean, so my question is it really good news that Benin, Cote d'Ivoire, and Kenya are going back to expensive debt, being cognizant of the whole problems around forex? Currencies are depreciating, right? So, and these are dollar-denominated bonds, so you're going to have to look for scarce dollars. So overall, would you say it's a good thing? I'm not sure.
Yeah, so you're right that the cost of this borrowing is higher than it was pre-pandemic. Yeah. We estimate, that the yields on these Eurobonds for non-distressed borrowers around 11% on average now compared to 7%. They're more expensive. Yeah. But the issue with borrowing is not so much whether it's a good or bad thing per se, but how you use the money and whether you're able to generate growth and both FX and domestic revenue in order to make sure that you can capture that rate of return and be able to stay current on repayments. So if that expected virtuous circle works well, then it makes sense. And for countries, we're always encouraging countries look for the lowest weighted average cost of financing that you can. And so if you can access concessional financing, that's great. And strengthen your macroeconomy, ensure that you're looking good on all these imbalance issues that we talked about, that you're having, low and stable inflation, and then your borrowing costs can be lower also.
Shouldn't the fund speak a bit more strongly about the risks involved in going back to the Eurobond market too quickly? I say this because, as you have already said, and as we all know, this type of commercial lending is what we call pro-cyclical. Mm-hmm. So they essentially give you money when you sometimes don't even need it, right? And when you're really in trouble, they don't give you any money. Unlike the IMF, who will give you money when you're hot. And that's my point. So maybe the fund should. I haven't read the full report. I don't know if the fund spoke a bit strongly about how careful countries should be, or not rushing going back to the capital markets, because they could be a false dawn, if you follow what I'm saying. Because your analysis of the region is that, look, the recovery is not yet fully done. We are still stabilizing. So why would I go and borrow at 10%? And it seems as if a lot of finance ministers seem to think once we are accepted in the Eurobond market, it means we've arrived. But we've seen many, many false dawns. So shouldn't the fund be stronger in cautioning around the dangers of this type of, some even call it predatory lending?
Well, I think countries are looking for financing, and often then, if they have significant redemptions due, they need to make sure they can roll those over, and the way to do that is, again, to access markets for liquidity operations so that the previous repayments can be rolled over. And that is what again, a lot of emerging market economies have progressed through, and it works well. I think you have to be cognizant, as you say, of the risks, the costs, and make sure that that borrowing then is well used, and that you're capturing that.
Maybe we should encourage more borrowing from the fund, because a lot of times your funding is almost zero interest, and it comes it's a concessionary loan, I guess. So you've given, I think, 34 countries $58 billion. That seems big, but it's not that big. I mean, the whole of Senegal's GDP is $63 billion. 34 countries, right? Shouldn't the fund be giving SSA more money?
So,
especially in times like this.
Right, yeah. So we're very proud that we've helped this many countries with that amount, which is much larger than what we used to lend to Sub-Saharan Africa. So it's large. And the idea of IMF financing is not that it can solve everything, but that it also can help catalyze other flows. So when the IMF helps a country signal this is a good, stable macro, and they've got an economic reform program that is on the right direction, then other donors also come in, and that is what we aim at. But you're right. We are really trying to make sure that, given this very high level of demand right now, so 27 countries, half of the Sub-Saharan Africa, are involved in IMF-supported programs. And there's a very high demand, and we want to make sure that our financing, our Poverty Reduction and Growth Trust, which funds this concessional lending, zero-interest lending, that's going to be well-resourced so that we can meet this high demand. And making sure that that's happening right now is even more challenging because given the high interest rates, getting subsidy resources to mark down the lending to make sure it's concessional, that's even more challenging. But that's what we're working on this year to ensure we're well funded.
Let's come to your second point around the imbalances, inflation and fiscal deficits. I think a lot of countries will be thinking about how do you cut budget deficits. One of the prescriptions of the program here in Ghana and other places. But you also have a strong development need. And budget deficit cuts can be painful, annoying, and even lead to civil unrest. So how do you, what's the balance? I think you released the paper on this. If you can just talk us through how to strike the balance between cutting a deficit in a country without undermining development.
So it's difficult, right, as you say, and we're just from the spring meetings in Washington where we meet with the policymakers from around the region, and that's what they highlighted too. This is really, really difficult. But there are things that governments can do. So when you think about this adjustment, which, as we've discussed, is needed because the debt is high and the interest to revenue is high. So if you don't adjust too, you're going to keep paying more of your revenues for interest. Okay, so you want to get that deficit and debt down. So how do you think about it? It's going to vary, of course, country to country, but we think there can be more scope often on the revenue side than the expenditure side. So right now, tax to GDP ratios in most sub-Saharan African countries are lower than what our gap analysis would say they could achieve, lower than peers, lower than what they could collect, even given their existing frameworks for tax rates and tax administration. So they could gain more revenue. So that's and we can talk more about those kind of areas. It doesn't always mean increasing tax rates. There's a lot of compliance issues. There's a lot of exemptions. There's a lot that countries can do using digital, etc. So there's that on the tax side. Then on the spending side, there's really important spending on capital, on infrastructure that's needed for growth. But some of that doesn't actually end up in building something. That a dollar that goes into the capital budget doesn't translate into actually a dollar of building anything. There's a lot of inefficiency. There's a lot of corruption. There's a lot of wastage and leakage. So improve that process so you actually get what you're trying. And then, protect your social programs or build them, because this consolidation can have negative impacts on, more vulnerable populations. And so build, social protection. I know here in Ghana, the LEAP program is something that's being, more, the benefits are being increased and the amounts, the people involved. So protect the social protection and protect, the education and health. That's what's needed for ensuring the future generations.
I take your point on tax. When people say tax GDP is low, the only thing I point out is that in a lot of informal economies, over 80% of Ghanaians are informal, we have a high indirect tax and very low direct taxes. So there's a lot of consumption and value-added kind of taxes, which inordinately affect the poor. And then taxes like property tax, which is supposed to be more progressive, they haven't invested in infrastructure to do it. So I think we need to qualify the points around taxes. And I take your point also on the tax exemptions, which then leads me to my next question, because you're talking about FDI to develop green minerals. Now, a lot of these international capital sees SSA, Southern Africa, as a high risk, high return environment. And a lot of times they ask for tax exemptions. So you want to attract FDI to develop lithium, cobalt, and all these things because that's what's going to drive your growth. But you may have to sacrifice some tax revenue to actually bring the FDI in. How do you resolve that? How do you get the quality FDI that doesn't just come and exploit the raw material export it raw, keep you poor, get all the tax exemptions in the world, but then on paper you still have some sort of investment in lithium. So just walk us through how this, your point around green minerals and attracting FDI does not conflict the tax point.
Great question. So we have this note on green critical minerals, which highlights that Africa is going to be a key player in this green transition. When you look at the proven reserves on critical minerals, 30% of them are in the region, and that's just proven reserves. Probably more is going to be there. So Africa could really benefit if they extract and export them raw. That would be a benefit because the prices of these are doubling, tripling, expected to increase tenfold. But there could be even more benefit if they're able to move up the value chain and do some processing. That requires, we think, a more regional approach rather than in each individual country, and requires FDI. But if you do band together more regionally, then the issue that you mentioned of giving tax concessions could be more easily addressed, because you could have regional tax treaties in the mining sector that would prevent this kind of race to the bottom. My country gives an exemption, and then the neighboring country says I have to match that, and none get the revenue. So there's the Africa Union Africa mining vision that could be built on to look at how you would work more regionally, also building on the Africa Continental Free Trade area, because to do that you'd need to improve connectivity so that the minerals could be moved across countries. You'd need to have more common investment protocols so that, again, you could have a regional hub for processing. But there's quite a bit of potential here.
As we wind up, and thank you so much for talking, we have, and elections are good things, right? But we have about 10 within the sub-region. We've had about 7 coup d'etats across the Sahel region. What is the, again, your prognosis is very cautious. You're saying we are recovering, it's going to be expensive to get money to do all of this. But what's the political and stability risk, I'm talking geopolitics now, of this recovery? How concerned should we be about the potential of elections creating flashpoints of conflict? Because there are disputed elections in some of these countries. And I'm not saying you should go into any specific country, but elections are great, but a lot of times in this country we go on edge. Elections affect, for example, the deficit. Almost every election year, deficit balloons, right? So it's not just the issue of security, it's also even sanctity to the budget. Elections do many things. So I suspect your outlook is more optimistic when I look at the reality of even the fact that there's so much uncertainty around the elections, the coups, and all of these things. So convince me that despite all the political things happening, growth will still be better this year and next year than in the previous year.
Yes, so indeed, this political uncertainty and the number of coups that we've had in the region are things that create this uncertainty and make then people unsure about investment and moving into different opportunities, or whether they should make big purchases. But on the election side, in fact, there are 18 national elections this year, more than that, so it's a bonanza. And that's a good sign, first of all. It's a sign of, a robust democratic process in a lot of countries. It is true that in sub-Saharan Africa, like in other places in the world, sometimes in election year run-ups, then that's the difficult, then there get to be spending overruns, or that's the difficult time to really continue reform. And our message in general is, stay vigilant, be aware, try to hold whatever the line is that the government is doing. And that, I think, gives us comfort that a lot of countries are making those commitments then to work during an election year, stick to their economic programs that are starting to deliver. So they can, say to the public, look, this is delivering. Inflation is declining. Where the exchange volatility is improving. We're accumulating more reserves. We're delivering, and so we want to stick to this.
So what's your final word to populations? I mean, Nigerians are struggling with the removal of subsidies. There's a lot of tough decisions being taken all over the continent where citizens are bearing the brunt of sometimes problems they did not cause. What's your message to the general public around staying true to the reforms? This is what our politicians tell us. The reforms will yield fruit. Are you optimistic that they would? What's the time frame?
I am, that they will yield fruit. There will be benefits. And there's so much opportunity in the region and so much positive dynamism, particularly on the private sector side, that it makes me optimistic that staying that course, and given all the potential in the region, particularly with young populations growing while the rest of the world is aging, that staying that course, building this foundation of macro stability for more inclusive growth is going to pay off, and that their governments have them in mind now, really thinking again, if there are things that are affecting the poor and more vulnerable, we're going to work to make sure you're protected.
Thank you for talking to us, Dr. Catherine Pattillo, Deputy Director, IMF Africa's Department. The release of the latest regional economic outlook for Sub-Saharan Africa. It's a recovery nonetheless, although it's not palatable and it's quite expensive. Thanks for talking to us.
Thank you.